Understanding price leadership, an in-depth analysis. Price leadership is a significant concept in various industries, particularly in oligopolistic markets, where a few firms dominate the landscape. This phenomenon arises when a leading firm has sufficient influence to dictate the pricing structure for goods or services across the entire market. As a consequence, rival firms often feel compelled to adjust their prices to align with the price leader if they want to retain their market share. In this article, we will explore the mechanics, models, advantages, disadvantages, and real-world examples of price leadership. What is price leadership? Price leadership occurs when a single firm, often referred to as the price leader, exerts considerable control over the market's pricing strategy. This is especially prevalent in industries characterized by limited competition and high barriers to entry. Examples of such industries include airlines, telecommunications, and automobiles, where few large firms dominate. Key takeaways. 1. Industry influence. Price leadership primarily exists in oligopolistic markets, where a small number of firms hold significant market power. 2. Response mechanism. Competing firms typically must follow the pricing lead of the price leader if they wish to preserve their market position. 3. Revenues and profits. A price leader's decisions can significantly impact the revenues and profits of all players within the marketplace, not just their own. How price leadership works. The emergence of price leadership is often contingent upon specific economic conditions. Market concentration. A limited number of firms operating in the market facilitates easier influences over pricing. Homogeneity of products. When products are similar, it leads to more straightforward price comparison and following. Inelastic demand. When consumer demand does not significantly change with price adjustments, firms find it more feasible to maintain price leadership. Long-run average total cost similarities. Firms with aligned cost structures may be more likely to follow the price leadership. These conditions allow a price leader to set market prices in such a way that drives consumer preference and demand. Types of price leadership. Price leadership manifests in three primary models. 1. Barometric price leadership. This model emerges when a particular firm can swiftly detect changes in market dynamics, such as shifts in demand or costs, and adjust prices accordingly. Even firms with relatively small market shares can act as barometric leaders if they are perceptive and responsive to market trends. However, their influence might be transient due to a lack of market power. 2. Collusive price leadership. Collusive price leadership occurs within markets where a few dominant firms explicitly or implicitly agree to set prices in alignment. Such agreements can stifle competition and often lead to legal scrutiny for price fixing. The larger firms can create a price floor that smaller firms are pressured to follow, which can inhibit competitive pricing strategies. 3. Dominant price leadership. In this model, one firm commands a substantial portion of market share, enough to act as a market maker. Smaller firms cannot influence pricing and might face challenges when trying to match the price leader's strategies. Dominant price leadership can lead to predatory pricing practices, where the price leader reduces prices to levels that drive competition out of the market. Advantages and disadvantages of price leadership. Advantages. Stable pricing. Price leadership can help stabilize prices within an industry, reducing the likelihood of price wars. Increased profits. By following the price leader's lead, other firms can also benefit from higher prices, provided that consumer demand remains steady. Resource allocation. As increased profits are generated, companies can invest in innovation and improved product quality. Disadvantages. Consumer impact. Heightened prices typically do not benefit consumers, they may pay more if a price leader raises prices. Small firm challenges. Smaller competitors might struggle to maintain profitability if they cannot match the pricing power of dominant firms. Potential for collusion. The thin line between price leadership and illegal collusion can lead to potential legal ramifications for firms involved in price fixing. Cost leadership versus price leadership. While both concepts deal with competitive strategies, they are distinct. Cost leadership: this strategy focuses on being able to produce goods at a lower cost than competitors, often resulting in the ability to sustain lower prices. Price leadership: this emphasizes a firm's capability to set and influence market prices, regardless of its production costs. Price followership. The opposite of price leadership is price followership, where a firm closely monitors and aligns its pricing with that of competitors. These firms may lack the influence to dictate prices themselves, leading to a reactive strategy. Real-world example: the airline industry. A quintessential example of price leadership is observed in the airline industry, where a handful of dominant firms often dictate pricing for specific routes. For instance, a major airline may announce fare reductions or increases, prompting smaller competitors to adjust their prices accordingly. With high barriers to entry, such as regulatory requirements and the substantial capital investment necessary for fleet acquisition, new entrants find it challenging to disrupt the pricing established by major players. Conclusion. In conclusion, price leadership is an influential aspect of market dynamics that can dictate pricing strategies in various industries. Understanding the types of price leadership, its economic implications, and its advantages and disadvantages enables firms and consumers alike to navigate market conditions more effectively. As businesses adapt to market conditions and consumer demands, the role of price leadership will continue to evolve, shaping the competitive landscape in complex ways.